Greetings, everyone, and thank you for joining us on the Elevation series today. My name is Thomas Gorman, and I'm glad to have the opportunity to talk with you about an important foundational topic in accounting, and that is cash versus accrual methods of accounting. The accounting method a business chooses affects far more than how numbers are recorded. It influences taxes, financial reporting, cash flow management, and overall decision making. Whether you're a small business owner, a manager, or simply looking to better understand financial statements, knowing the difference between these two methods is essential. Today, we'll walk through how cash and accrual accounting work, their advantages and disadvantages, and when it may make sense for a business to use or switch between these methods. By the end of this session, you should have a clear understanding of which approach best fits different types of businesses and why that choice matters. Now, the reason we are doing today's presentation is because I've received a number of questions from some of our clients about, what is cash accounting? What is accrual accounting? What do these mean? What are the differences between the two? So today I wanted to put together a quick little presentation to break down each method to give you guys a little bit more information about what these methods are and which one you should be using for your business. So, in a nutshell, accounting methods determine how businesses record and report income expenses. Um, and the two main methods for doing that is cash accounting and accrual accounting. Now, choosing the right accounting method affects tax obligations, financial reporting, and decision making. Um, so we're going to take a look at each one of these and break them down piece by piece so that you'll have a complete understanding. Now, we're going to begin today with cash accounting. I feel like cash accounting is probably going to be the appropriate method of accounting for 85% of Climb Fund clients. And the reason for that is that cash accounting is a method that is, um, a lot simpler. And it basically tracks cash when cash moves. So when revenue moves, that's when it gets recognized. When expenses are paid, that's when that expense gets recognized. So anytime we have a movement of cash into or out of our business, that's when we recognize that expense or that's when we recognize that income. Now, when I say recognize, it means that's when it officially gets recorded on the books. Um, so, cash accounting works for small businesses with, not a lot of moving parts because it's simple to maintain and it's good for small operations. And it's ideal for businesses with limited inventory and straightforward cash flow. So, we're going to take a look at the pros of cash accounting. Um, but before we do, I just want to, kind of drive home the point again that uh, cash accounting recognizes cash or recognizes income or recognizes expenses when cash moves. So if I do a job for you today and you don't pay me until the middle of next month, if I'm using cash accounting, I don't record that income on my books until the middle of next month when you pay me. So if any expenses come along with the product and service that I provided to you, those expenses are going to be sitting on your books without any revenue to go along with them. So I hope that gives you a clear picture as to what we mean when we say cash accounting. And so, in terms of cash accounting, what are the benefits? Well, the biggest benefit of this accounting method is that it is simple and easy to use. Cash accounting requires recording income only when cash is received and expenses only when they're actually paid. So, if I purchase, um, let's just say I purchase something on account and it's not paid until, 10 days into next month. 10 days into next month is when I will record that expense on my books. So, it requires minimal bookkeeping. It's ideal for freelancers, sole proprietors, and very small businesses. Um, if you have a small business with a lot of inventory on hand, and you buy a lot of inventory on credit, there can be a case to be made that maybe in that instance you should be using accrual accounting. But for the majority of small businesses, cash accounting is going to be ideal simply because it's so easy to use. Most small businesses don't have accounting processes and procedures in place. So it's just a really good fit for small business. Another reason why cash accounting is beneficial is because it gives you a clear view of your cash flow. And that's very important for small businesses, especially small businesses who are in the startup phase, maybe in the first 2 or 3 years of operations. Because generally speaking, businesses in the first 2 or 3 years of operations are constantly fighting cash flow battles, making sure that you have enough cash on hand to pay all of the expenses that you have. And the cash accounting method gives you a very clear picture with regards to the cash you have on hand because it tracks actual cash movement. It gives an accurate picture of how much money is on hand. And it can help with short-term financial decision making because you always know what your short-term cash situation looks like. Because this accounting method is focused so intently on cash moving in and cash moving out. Now, additionally, there can be some tax advantages to using the cash method of accounting in some situations. In a situation where you don't pay taxes on income until it is received, not just invoiced. So let's just say, you know, I do a job for you or I sell you a product late in November or no, late in December. Let's say late in December. You don't pay me until early January. Now, in this situation, I have earned the cash in the calendar year of December, but I'm paid the cash in the calendar year of January. Therefore, I don't have to pay any taxes on that until the calendar year of January on that income. Um, so, using the cash accounting method can delay income recognition near year end by delaying billing. Now, obviously, there are legal and ethical limitations to this. We don't, it would be very unwise of someone to try to take all of their December revenue and delay that until January simply because you've already racked up a big bill in the calendar year that December is in. A big tax bill I'm referring to. Um, so cash accounting can help you, delay billing, which can, offset some of your income tax liability until next year. And then the final advantage of a cash accounting method is that it has lower administrative costs. You don't need to have um, nearly as much knowledge about accounting and bookkeeping to administer a cash accounting system than you do with an accrual accounting system. And additionally, you also spend less time reconciling accounts and preparing financial statements because everything gets recognized when it comes in. You don't have to worry about, you know, I paid for this expense today, but it's going on a job that won't be completed until, 2 months from now. Everything gets recorded when the cash moves. So it makes things easier to administer. Um, and so that's cash accounting. Um, that's cash accounting benefits. Now let's look at some of the cons, or the drawbacks to cash accounting. So cash accounting is not GAAP compliant. GAAP means generally accepted accounting principles. So if you are a C Corp or other types of businesses that require you to use accrual accounting methods, cash accounting can't work for your business. Um, Additionally, a drawback is that because of the way things are accounted with cash accounting, um, there can be a bit of misrepresentation on your financial statements. So, an example would be I begin a job in November, I purchase all of the materials, then I spend November, December, and the beginning of January finishing the job, and then you pay me for the job at the midpoint of January. Well, I've incurred an expense way back in November, and there's not any corresponding revenue to go along with that expense in November. So your profit and loss is going to not look as good as it could in November because you've taken on those expenses, but you haven't received any revenue for them. Even though you're going to get paid for the job, but that money doesn't show in November. So it can cause your financial statements to not show the complete picture of what's going on. And that's because it ignores accounts receivable and it ignores accounts payable. Both of those are, paid in the future. So, with regards to misrepresentation on the financial statements, you can have high profits even when big bills haven't been paid, or you can have low profits even when the business is actually owed substantial revenues. But because of the way it's recorded, it doesn't show it on the financial statements, and that can be a problem sometimes. you know, and that comes right into number three, with, you don't have matching revenues and expenses in the period in which those are created. And it makes period to period comparisons difficult because, as we said, we've paid expenses in, November of one year, and then we're receiving revenue in January of another year. So, it's throwing the numbers off and not showing that complete picture that business owners really need, to maximize their decision making. Um, and, with regards to that picture not being complete, it brings us to number four, which is limited financial insight, because um, things are harder to analyze with regards to profitability and operational efficiency when you're incurring debts or expenses in 1 month and then revenues 2 or 3 months down the line. And then, if we're using the cash accounting method, And then we start thinking about going out to find investors for our business, or maybe we need to, um, maybe we need to get a small business loan to take our business to the next level. Those cash accounting financial statements can be a drawback in those situations. So, um, you know, it has its benefits, it has its drawbacks. Most businesses are going to begin their life in the cash accounting phase or the cash accounting method. And then as they mature over time and get more complex, at that point, they will transition into the accrual accounting method. And so now we need to hop in and kind of define what is accrual accounting and how is it different than how is it different than cash accounting. So with cash accounting, we said that transactions are recorded when cash moves. In accrual accounting, income and expenses get recorded when economic activity occurs, as opposed to when cash moves. So, the revenue is getting recognized when it's earned, regardless of when you get paid. Um, and so the expenses get recognized when they're incurred, the income gets recognized when it's occurred, not necessarily when you receive the money. And through doing this, you can provide a more accurate financial picture of what is actually going on in the company, um, because you're able to take a more accurate snapshot of what's happening in the company. Um, with our example earlier of, you do business you begin a job in November, you incur the expenses in November, but you ultimately don't get paid for that job until the middle of January. That's using the cash accounting method. But under the accrual accounting method, you would claim that income in November, because that's when the economic activity occurred. That's when the agreement was made that we're going to do X, Y, and Z for this amount of money. Um, and so, accrual accounting is better suited for businesses with inventory, with credit sales, or with complex operations. And so I hope that gives you a better idea, or paints a rather clear picture of the difference between cash accounting and accrual accounting. So then, what are the benefits of accrual accounting? Well, we've already uncovered one, and that is more accurate financial picture. Um, you know, Accrual accounting records income when earned and expenses when incurred, regardless of when that cash changes hands. Um, and so, we're getting the information earlier rather than later. And when I say we're getting the information, that information is appearing on our financial statements. Um, Now, additionally, uh, accrual accounting is GAAP compliant. And remember, we said GAAP means generally accepted accounting principles. And, GAAP compliance is necessary for most medium to large businesses. It's necessary for businesses seeking investors or bank financing, because investors or banks, they're going to want to see your financial statements, and it's going to be their preference that your financial statements are based on generally accepted accounting principles. And it's also necessary for companies with audited financial statements, because these are you know you know scrutinized by an auditor, and verified to be accurate. Now, another benefit of making the switch over to accrual accounting is that it's better for long-term planning. Your financial statements are now, when you use accrual accounting, they're going to represent your future receivables and future payables, whereas that information did not show up on the profit and loss of a company who is using cash accounting. And so, when we get that additional information on our financial statements, it can help with forecasting your cash needs, projecting your profitability, and improving the long-term performance of your business. Because one thing we've consistently tried to hit home here on the Elevation series is that we want businesses making decisions based upon data, accurate data, timely data, and we want as much of that data available to the business owner when decisions are being made as possible. And so for those reasons, for long-term planning, the accrual method of accounting is superior. Um, and number four just kind of goes back to that point, which is, we get matches with revenues and expenses properly. We don't have, expenses showing up on November's financial statements and then revenues connected to those expenses popping up on January. So it makes things easier to compare. It aligns income and the expenses incurred to generate that income, which then produces a clearer, more useful financial statement. Um, and lastly, the accrual accounting is essential for inventory-based businesses. And in fact, it's required by tax law in many cases when inventory is a material part of the business. And it gives a more accurate picture of the cost of goods sold and changes in inventory because you're now tracking these things and they're showing up on your financial statements, rather than being pieces on this financial statement and pieces on that financial statement, which as the business grows and grows in complexity, that's when it really starts to affect the data that business owners are using to make their decisions. And at that point, that's when it's really recommended that you switch over from cash accounting to accrual accounting. Now, you know, the way we've just described this um, makes accrual accounting sound far superior to cash accounting. And from a decision making standpoint, it really is. But cash accounting also has a purpose for new businesses, for simple businesses with, all of the things that we talked about earlier. So then, well, what are the cons of these of accrual accounting? And well, it's more complex and costly. It's going to require more detailed bookkeeping. You may have to, instead of being able to do things on your own with just you and your QuickBooks, you may have to go out and hire a bookkeeper or an accountant to have on staff, because it often demands accounting software or professional support when we're looking at this more complex accounting system. um, and so that is something that early on in a business's life you want to kind of shy away from those added expenses, even though those added expenses in the long run, they're going to help you make better decisions. In the short run, most startups are strictly focused on survival. Those first 2, 3 years, survival is the name of the game. And while you you could make better decisions, more informed decisions, by having these higher quality financial statements. It's going to come at a cost. And generally speaking, in the early years of a business, that cost is not worth the benefit of an accrual method. Um, and then, accrual accounting can then sometimes be misleading for, um, tracking your cash flow. So, a company may appear profitable, but have little cash on hand because income is recorded before the company has received that money. Um, and so what that means then is if you're using an accrual method of accounting, you're probably having to do statement of cash flows in addition to your profit and loss statement. Um, with a cash accounting method, your profit and loss statement is going to be pretty on point with regards to your cash flow because, as we said earlier, it's recognizing money when it moves, not when economic activity occurs. You're not recognizing income before you actually get paid. So then with accrual accounting, um, you're going to have to, do some cash flow forecasting, or at the very least, you're going to have to be analyzing your statement of cash flows every month, which is another form of financial statement. Most of the time, when we talk about financial statements, we talk about a profit and loss and we talk about a balance sheet. Um, but a statement of cash flows is another form of financial statement that folks that use the accrual accounting method refer to quite frequently because they need that additional piece of the puzzle to know exactly where they stand with regards to their cash flow and cash on hand. Um, and then there can be some potential tax disadvantages with accrual accounting, just like there were some potential cash advantages with the cash accounting method. With the accrual accounting method, you must pay taxes on income when it's earned, not when it's received. So if we go back to the example we've been using, you begin a job in mid-November. You get the um, you get the expenses incurred in November when you incur those expenses, but then you're also going to be recognizing that revenue in November, even though you're not going to be receiving that revenue until the middle of January. And so when we recognize that income in November, well, that means we're going to be paying the taxes on that income in the calendar year that November is in, not in the calendar year that January is in. So you may actually be paying taxes on cash that you actually have not received. And this can increase the tax liability for a business if customers are slow to pay or if jobs are spread out over, a period of months. And then lastly, accrual accounting requires more management oversight. So, you know, when we've got our accounts receivable and our payables popping up on these financial statements with the accrual accounting method, that means you have to track these more closely. You've got to track your receivables, your payables, and any deferrals on an ongoing basis. And you've got to make sure that they go in the appropriate time frame. And so it's going to require more management oversight. And then errors or omissions can have significant impacts on financial statements. But I guess that can be said of the cash method as well. I think it just gets magnified a little bit more when we are using the accrual accounting method. So, to kind of summarize the differences between cash accounting and accrual accounting, the biggest difference is, the recognition of timing. Uh, Cash accounting, we recognize when the cash moves. Accrual accounting, we recognize when the economic activity occurs. And we've established that because um, the profit and loss statement and the balance sheet are now going to be reflecting accounts payable and accounts receivable. They're also going to be more accurate in terms of what they are showing for your profitability. So the cash method may misrepresent performance during timing gaps, and accrual supports better long-term financial planning. So that kind of basically summarizes the differences between the two. And so, as I said earlier, most businesses are going to start out in the cash method of accounting. And as the business grows over time, um, you know, as it gets more complex, more mature, at some point you will transition from a cash accounting method to an accrual accounting method, because at that point the costs are going to um, be worth the benefit of doing that. And so as you attain more customers, as you attain more suppliers, or you start making more credit transactions, that's really when the accrual method is going to be beneficial for you to switch to. Additionally, inventory usage typically requires accrual under accounting rules. Um, and there's a little bit of a gray area there. There's a lot of small businesses out there that keep small amounts of inventory on hand, but still use um, the cash method of accounting. Um, but generally speaking, those are businesses that are not, inventory is not a heavy part of daily operations. And, if a business is reaching a stage where it's ready to take the next step in its growth, where you have to go out and seek investors, you have to go out and seek small business loans, um, those those are circumstances in which it's going to prove beneficial to you to evolve your accounting from cash to accrual, because investors and banks are going to want to see the most accurate financial statements that they can see. And, as we said earlier, that's going to be your accrual method financial statements. And then, when there's a need for more accurate financial insights in terms of, okay, it's no longer beneficial for me to just project my business's financial performance 6 months. Once you start putting together long-term plans, like we're putting together a 3-year plan for this business, um, deeper financial insights are going to be needed to do that. And to get those insights, you're then going to need to swap over to the accrual accounting method. And then lastly, when required by tax law or GAAP reporting standards, obviously at that point you don't have a choice. You have to switch over to the accrual accounting methods, um, because mandated by law or whatever the case may be there. Um, so there are some considerations we need to make um, before we do the switch. We want to evaluate the impact on our tax obligations, because as we've seen, the type of accounting method that you use can affect when you recognize income, which can then have an effect on your tax obligations. So we want to have an understanding of that. We want to we want to have a conversation with our CPA, because, we want them to be aware of what we're doing, and they need to have all of the applicable information for when we make the switch from cash accounting to accrual accounting. So when we're thinking about making that switch, one of the first things we need to do is reach out to our CPA and have a conversation with them. Um, if you make the switch from a cash basis to an accrual basis, we may need to look at the internal processes of the business to be sure that all of our accounts receivable and accounts payable are going to be, that information is going to be available for when, the bookkeeper, the accountant, records things and puts things on the books. And lastly, we need to understand the initial setup and potential one-time adjustments that need to be made, and that does include those internal processes that we're going to need to adjust to make sure that all information is being tracked properly and in a timely manner that conform to accrual accounting methods. Um, so that's pretty much what we've got for you today. I put this presentation together because we've had multiple clients reach out and ask which accounting method they should be using, what are the differences. So I hope this provides you guys with a little bit of insight, a little bit of knowledge about, accounting methods, which one is right for you and your business. But again, as I always say, let this be the beginning of your education on accounting methods, not the end of your education on accounting methods. So thank you so much for being with us today. We'll see you next time on the Climb Fund Entrepreneurial Elevation Series. Thank you so much.